Okay, so now we're going to reach a more technical step, something you are familiar with, but as you'll see, when it comes to project finance, there are some specific difficulties. I mean that project evaluation, this is a topic which you have covered to a certain extent in corporate finance. Now we'll see the type of difficulties which we have to deal with when it comes to project finance. Well, basically, the difficulties come from the fact that there are complex financing strategies, and you'll see that the traditional distinction between debt and equity is not quite relevant when it comes to project finance because of all these type of instruments which we classify as quasi-equity. So we don't know exactly where is the limit between debt and equity. So calculating the WACC, as we'll see, is a challenge. And there are other solutions proposed as an alternative to the traditional discounting using the WACC. Okay. The other problem is that most of these the projects concerned in project finance, are, let's say, global projects. What I mean is that they take place usually in a country which is a country which is not the country of the investors. Those who are bringing the money are usually coming from many other parts of the world, okay? And they invest in a country which might be risky with a particular country risk. So all these elements have to be taken into consideration. Very often also, that's another tricky point, it's a multi-currency project, meaning that you may have to invest in a particular currency for most of the expenses, but then having cash flows in different other currencies and so on. So this multi-currency aspect, together with the multitude of financing instruments which are used with a difficulty to make the difference between debt and equity, as well as the global dimension of the project, makes it a bit difficult, so that the traditional solutions which you have seen in corporate finance are not directly applicable. Okay, so we'll see what are the methods which can be used to evaluate the project. Okay, so let's move directly to this chapter now. Okay, here you recognize all the slides we have discussed, and now we reach the point which is here. Project evaluation, which is the third point. Well, so let me remind you what you know. Okay, what are the most common criteria which are used? Well, the net present value. Okay, so net present value, which is the dominant criteria when it comes to project evaluation or investment project evaluation. Why? Because it's a measure of value creation. Precisely what it means, you have seen that with my colleagues in corporate finance. If you invest €1 million, okay, and if your the value of future cash flows, discounted cash flows indeed, is, let's say, 1.2 million, it means that 1 million which you spend is immediately transformed into 1.2 million because of the project. In other words, if you transform 1 million into a value of future cash flows, which is 1.2 million, it means that your project will create 0.2 million of additional value. Okay. Sometimes we use also a criteria which is rather than just the NPV over the capital invested. Okay. Why? Because if you want to compare projects, you may like to know, indeed, they may have different size. So some people would consider that it's relevant to look at the value created for €1 invested. Well, as far as project finance is concerned, well, forget it. Okay. Why? Because these are capital intensive projects, and one of the problems with this criteria, NPV over capital invested, you probably know that it tends to, let's say, overvalue to a certain extent the small projects, non-strategic projects. Here we are talking a long-term capital-intensive project, so the NPV over capital invested doesn't make much sense here. Okay. Well, that's the NPV, and it will remain indeed a central element in our discussion. Well, you also are quite familiar with the internal rate of return. Okay. You know also that there is a kind of, let's say, close relation between the NPV and an internal rate of return. Okay. Well, you know that if the NPV is positive, it means that the internal rate of return is higher than the WACC. Okay. I guess you remember that, which is a key element. And internal rate of return and NPVs are used alternatively, because to a certain extent, if you use the WACC, it's the same to say that with the WACC, the NPV is positive, or the internal rate of return is higher than the WACC, then the NPV is positive. Well, there are a few discussions which you probably had in the course. There is the issue of the cash flow reinvestment. There are some assumptions which are made when you use the internal rate of return. And you probably know also that it can be ambiguous if you compare exclusive projects. If you make comparisons, it's not quite sure that a project with the highest internal rate of return is the best project, because a project with a lower return, a lower internal rate of return, might still have a higher net present value than the other one. So I don't want to discuss all these points which you have seen already. The only point I want to stress is that in both cases, the NPV and the internal rate of return, to make a decision, you need the WACC. Okay, you need the weighted average cost of capital, which is, as you know, the weighted average, because we consider traditionally that there are two sources of funds, debt and equity. Okay, with a weight for each and a cost for each, so that you have a weighted average. Well, but behind that, you have a very simple idea, that there are two sources of funds, debt and equity. Well, as I mentioned that to you already, in project finance, it's a bit trickier, because, well, getting the WACC is not easy, because there are many types of instruments, and not only this, because the capital structure is continuously changing during the project period. Okay, so you cannot count on a WACC which would be a WACC applicable for all the years of the project. Okay, so that had to the difficulty. So we'll see how we can still maintaining the idea, the principle of the NPV, but you'll see later on, which I will introduce a concept which is the APV, adjusted present value, just to find a solution to these difficulties related to the WACC calculation. Okay. You probably have heard of the payback also, which is a quite common practice, particularly for small size and medium-sized companies. Okay, as far as project finance is concerned, forget the payback. Okay, first of all, it's not a measure of profitability. A payback is just the number of years or the period you need to get your money back. So it's not a measure of profitability. It's more a measure of liquidity. That's why small companies often use it, because small companies may have a difficult access to financial resources. And in this case, when a small company invests, well, the company is keen to get the money back, to have a quick profitability, so that the company can reconstitute its cash position and eventually invest again. Okay, so it's more a reference to liquidity. It can also be seen as a risk indicator, because there is also the idea that when you have got your money back, well, you are not going to lose money. Okay, if you get your money back, it means at least you got your money back. Okay, you didn't lose anything in terms of capital loss. Okay, so if it is a short delay, well, you can have good prediction for the short term, and then you say, well, the risk is not too high, because I'm going to get my money back soon. Okay, but the payback, again, I just wanted to mention it on the list of traditional criteria, but as far as project finance concerned, just forget about the payback. So basically, we are going to focus on the NPV, which is the basic measure, but with some adjustment. That's why I will present later on what we call the APV, which is the adjusted present value. It's the same spirit, the same idea basically behind, but with some adjustment to make it easier, because of the difficulties to determine precisely the WACC. Well, so now let's focus more precisely on the evaluation of a project as part of a project finance case. It means typically an infrastructure project with a lot of money to be invested in the first place and a long period of time to get the money back. Okay. Well, actually, the value of the project will depend on the future expected benefits generated by this project. And then you have two approaches. Okay. these benefits, indeed, as we said before, they have to be estimated in the first place and then discounted. Okay, that's the same as the NPV principle. But there are two approaches. One is, and they are not exclusive. I mean, both are developed. One is socioeconomic, and the other one refers to the market approach, typically using methodologies like this, what is proposed in the framework of the CAPM, the Capital Asset Pricing Model. Okay, so let's start with the socioeconomic approach first. Okay, what does it mean? Rather than just looking at the functional performance of the project, you know, when it comes to projects in infrastructures, public infrastructures, you can imagine that the reference cannot just be in terms of pure profitability. Okay, in other words, rather than assessing effective expected cash flows, all type of what we call externalities, which is the word you are probably familiar with, okay, which can be either positive or negative, they need to be identified, and as much as we can, because it's not always easy, these externalities should be identified to provide a more complete picture of the project. The idea is to consider the impact of the project on the society at large, including the impact on the economic development. If it's a positive impact, that would be typically what we call a positive externality. For instance, a project might contribute to develop a certain know-how locally, may contribute to increase the expertise of the people, local people involved in the project. It may create all types of jobs and so on. You also have to look at the environmental impact. You know, it may be a problem from the environmental point of view if it creates a bit of pollution, or if you have too many CO2 emissions and so on. That would be a negative externality. What about the impact on the well-being of people, and so on and so on? So you see, these are non-financial elements, not easy to assess, but which are more and more taken into consideration, and they are given more and more importance. Okay? Well, so once you have identified all these externalities, now you need also to try to give a value to these externalities, which will be added to the pure financial value. Okay? And since this impact may not occur just immediately when the project is developed, it's, you know, if you take the case of the economic development, or if you take the case of a negative externality, that would be kind of deterioration of the environment one way or another. This happens over time. So there is a discounting issue. Okay? If you can give a value, for instance, to the destruction of part of the environment, and this can be done because there are specialists in environmental science who are proposing ways to value that, and I will give you some references later on. Okay, well then, if it's an impact that occurs in, let's say, 50 years from now, which, when it comes to environmental issues, is an horizon which is quite normal. You see, the CO2 emissions. Well, some people would argue that we start feeling the impact, but you know, it might be much worse in 50 years from now. So we have to look at 50 years. So we need to introduce a proper discount rate. Okay, so I'm not going here to present all the arguments to justify the practices as far as discounting, let's say, environmental impact on negative externalities are concerned. Okay, but you should know that we are not using the CAPM references because it wouldn't make much sense. We use rather a policy rate, you know, and you just have to know. For those who want to know more about this, I give you some references here on the slide. Okay, but what you need to keep in mind is usually the discount rate is much lower than what would result from a CAPM approach. Okay, it is much lower, and it is declining over time. I'm not going to go deep in the explanation for that, but you know, I will give you an argument, okay, which apply very well for instance, discussion around the nuclear energy, for instance. You know, one of the problem with the nuclear energy is, what are we going to do with the waste? Okay, and but if you develop a nuclear project, you know, the duration of a nuclear plant can be around 50 years. And then decommissioning the plant, it may take another 20 years. So in other words, we are looking at an horizon of more than 50 years. On average, they say 60, 70 years. So whatever the value you give to the negative impact of waste treatment, if you discount, okay, in 50 years, it will not be much. Because even if the discount rate is rather low, you know, if you have 50 years of discounting, what it represents today when you make the decision is just nothing. And that's why there is discussion behind that, because those who are against nuclear energy would say, well, you discount, which means that you are depreciating the future. You know, you have to understand that depreciating means that you give less value to something which is going to occur in the future. Okay, that's why we discount. You would say that 100 in 1 year from now is less than 100 today. Okay, so you discount, you depreciate the future. So, and these people, they argue that if you look at 50 years from now, it's unfair to do so because it concerns the new generation. In other words, the future can also be seen as the present time of new generation. And why should we depreciate this time? Okay, so I'm not going to go further in the discussion. If you want to know more about this and more details, you have the references here down there. But that is a kind of idea you can keep in mind to understand why the policy discounting rates are normally much lower than what we use when we refer to the capital asset pricing model. Okay, so having said that, now what does it mean when we say negative externalities or positive externalities? It has to do with what we call ESG right now. You know, you've heard of that probably. ESG stands for environment, G is for governance and S is for social, sorry. Evolution, well, it concerns environmental, social, and governance, as you can see here. Well, and you have all the type of elements that can be taken into consideration in this let's say, economic impact. Greenhouse gas emission for the environment, waste pollution, land use, water use, all these things are considered for a project. We try to assess the impact of the project on all that. You know, what about CO2 emission? What about the generation of waste and how they can be treated? What about the consumption of water? You know that water is a key problem for the future. What about land use? Okay. If you want to maintain biodiversity, if you want to make sure that there is enough land available to feed the planet, well, these are the main elements considered for a project to assess its environmental impact. Then you have a social impact. How will the project, what kind of impact on the workforce and the diversity? What about the impact on the safety of people? Okay. There are some dangerous, for instance, mining projects in mining have a very negative assessment at this level because usually these are dangerous activities, highly polluting, and with a quite negative impact on communities, for instance. Okay, what about customer engagement? To which extent is the project well in line with what customer and what the people, the public at large, expect from you? Okay, and finally, governance. What are the codes and values behind the project? Transparency and reporting. Can we really trust the document, the information provided by those who are promoting the project, and so on and so on? Well, the cyber risks and system is mentioned here because, you know, it's a real concern. So that the governance has more to do with investors which they want to know not only about the expected profitability, but also sometimes they are also concerned with the codes and values of the company if they value also sustainability and social impact. Okay, and transparency is indeed key for them. They want to make sure that they know all the truth, that they are well informed about what the company is doing. Okay, so these are the main components of a social economic analysis of the impact of a project. Well, but how can we assess all these things? I would say that it is not quite clear yet, okay? But there are lots of efforts made to put in place, to develop a kind of methodology to assess all these dimensions. And among the major reference that exists today, you have the so-called GRI sustainability standards, okay, which is today considered as a global reference, okay. So the GRI standards represent global best practice for reporting publicly on a range of economic, environmental, and social impacts, you see. Sustainability reporting based on the standards provide information about an organization's positive or negative contributions to sustainable development. You have the reference below also. So, but if you are concerned with that, if you need to have more detail about how to assess this point, just go and look at this web link and you will find all types of details. Okay? Well, so having said that now, let's discuss about the discount rate. Okay, we know that a project, if you want to evaluate it, you need to have an idea of all the consequences of this project in terms of, in financial terms, in terms of cash flows, but also in terms of impact, as we have seen. Well, but future cash flow have to be depreciated. Why? You know the reasons. They are not immediately available. Then behind that, you have the idea of time value of money. The later the cash is coming in, the less it is worth today. Okay, I don't need to insist on that. Well, cash flows in the future are necessarily more or less indeed uncertain. And then that's why the discount rate will include the risk premium to take into account the time value of money, plus also the fact that a future value is never certain, and therefore you need to take into account this uncertainty. This is what is done through a risk premium. I want to add something which maybe you are not familiar with. If the cash flow, which you expect in the future, is generated by the sale of one asset, a particular asset. For instance, you may decide that at a point in time you will sell a piece of land, or you will sell an equipment, an old one, to buy a new one. Well, in this case, there is a liquidity issue, because you have to imagine under which conditions you will be able to sell back your asset. Okay, some assets are very liquid. Okay, which might be the case if you have a well-located real estate asset. Okay, but some other assets might be much less liquid, and which means in this case that their value must be discounted also, because we should include a liquidity premium if the asset is not considered as very liquid. Okay, so these are the traditional elements taken into consideration for determining the discount rate. And I would say that financial markets provides indication for these elements. For instance, the time value of money can be obtained if you look at the interest rates for certain maturities. Indeed, it depends which maturity you consider, but I guess you are familiar with the concept of yield curve. I mean, the yield curve on the euro or on the dollar, for instance, would tell you what is the basic rate, the risk-free rate, as we call it sometimes, for this particular currency for a particular maturity. Okay, what about the risk premium? Well, you know about the CAPM. Okay, well, we'll come back to it later on a bit to discuss a few points, but here the market can give you also an indication to calculate a risk premium. Okay, it is a bit trickier for the liquidity premium, for which you don't have much reference on the market. But altogether, people would accept the idea that you can find some indications to determine the discount rate using market data. Well, except that I have indicated here, and I raised the issue of relevance of this approach with a question mark, because some people would rightly argue that today the markets are a bit crazy. Okay, and whether you can take market reference as a reliable starting point is not so sure. The problem is that if you don't take the market data, what do you take? Nobody knows. Okay, so and that's why the period we are experiencing now is a bit tricky, because when you have negative interest rates, for instance, it's obviously something which is not quite normal. So can you really take the market references as a strong basis to evaluate future projects? This is really very questionable today, and it adds to the difficulty indeed of evaluating a long-term project. Well, but if we come back to what we said before with reference to ESG, you know, ES standing for environment and social, and G for governance. We sometimes use, we probably have heard that also, the concept of impact investing. Well, so there is another reason for many investors for depreciating future cash flows, which would be, as we said before, a negative social and environmental impact. You know, if a project is seen as a dirty project, and it is the case today to a certain extent, for instance, it's interesting to look at what's happening right now in this domain, in this industry. If you're in the oil and gas today, if you are looking at an oil and gas project, believe me, the cost of fund is increasing. Why? Because many investors, they just refuse to invest their money in oil and gas because they consider that we should stop drilling and stop taking these resources out of the ground because of the CO2 emission and the negative, very negative impact on the environment. Okay, in other words, you know, if your project is seen as kind of dirty, if you say, with a negative impact on society at all and on the environment, then, you know, a lot of investors will refuse to invest there, which means that if you want to finance a project, you need to accept people who are going to invest, but they are going to be much more demanding. In other words, the cost of fund would increase, okay, for projects which are considered as having a negative impact, okay? And I'm mentioning that today because, you know, it becomes more and more an issue. Responsible investors, as you have a comment here on the slide, responsible investors may be less demanding for sustainable projects in line with ESG requirements. You know, responsible investors, they like clean projects and they accept to finance, even if the return is not that high, they are less demanding. If your project has a negative impact, well, the investors you are going to find, they might come to you, but they will be more demanding. In other words, the cost of fund will be higher. And if you look at the progression of ESG funds, which reflect also the amount of money which is invested in what we might call a clean project or a project with a high ESG rating, you see that it's growing impressively here. You know, it started, the growth started, the momentum started in 2014, you see, and we have an exponential curve. Okay, that's why, you know, this has to be taken into consideration more and more. Okay, so let's look a bit at this a bit more in depth. Okay, here it's interesting to look at this. You have comparisons between two sets of companies, and you have the return, the sustainable index, which you compare to the global index, and you have the total return for each of these indexes. So what is the sustainable index? The sustainable index is a market index which is based on a sample of companies with good high ESG standards, okay, and recognized as such. Okay, you have, for instance, the S&P Composite 1500 ESG index, okay, and you have also the Dow Jones Sustainability World Index. Okay, these two, and these are the green column here, well, represent the performance of following two index considering and valuing sustainability. Well, you see that in both cases, whether you take the Dow Jones Index or the S&P Index, that sustainable companies are doing better than the others. The SP 500 has a return which is of total return which is of 18.70%, whereas it is 2023 for the S&P Composite ESG Index. If you look at the Dow Jones, you also have a significant difference. It's even much bigger. The Dow Jones Composite average is below 10, whereas it's 1564 for the Dow Jones Sustainability World Index. Okay, so companies which distinguish themselves by effective efforts to improve their governance, okay, social and environmental impact, they display higher market performance, apparently at least. The question we could ask indeed, but how can investors value long-term social and environmental impact? You know, here you have a list given by S&P or by Dow Jones of what companies that would be good, but there is still a question which is highly discussed today. So how can you recognize clearly whether a company is doing well? I say a company, but it could be indeed a project. It is doing well for the environment or has a good social impact or whatever. You know, I was surprised myself to see that if you look at the ESG rating for, let's say, for instance, for the Dow Jones Sustainability World Index, I think one of the company which is doing very well in this ESG rating is a tobacco company, you know, American Tobacco Company, ATC, well, is ranked very well. So why? Probably because they have a good governance, probably investors are well informed, probably because they have a proper behavior towards their employees and so on, they treat well. But the interesting thing to notice also is that, you know, they produce tobacco, which is known to be dangerous for health, and there is not much doubt about it, but it's still well ranked for ESG. So there are lots of discussion to see whether this, how can we recognize really what is good and what is bad for the environment and for the social development of a country. So, you know, the idea is there. There are more and more ESG funds, but there are lots of discussion also to see how we can rate and how we can value really and assess the impact of each company on the environment and on the society at large. Well, the comment here is, frankly, I don't know concerning the environmental impact. The time horizon is so long and uncertainty so high. It's true that there are difficulties to assess that. So even though you have indexes there and some people trying to measure it, well, we should be careful. Well, to give you an illustration of that, using a particular project, I'll come back to your Vietnamese project, Legan Wind Farm project, which I presented in the introduction. Okay, well, it as part of the preliminary studies, because it has to be done before the project start, because it's part of the evaluation process. Okay, so in the case of Legan Wind Farm project in Vietnam, well, a company called NIRAS has been awarded several millions of US dollars to conduct an international standard environmental and social impact assessment, okay, for the project. So what type of points have they investigated? It'll give you the type of investigation which are necessary, and indeed these points here make sense for a wind farm project. It would be different for a refinery or for a toll road. Okay, so let's look, however, at what was concerned here: the sampling of seabed and water using traditional methods and state-of-the-art underwater cameras to record plants and animal life and their environment. So you see, they look at the what's happening under the water, where the project will be developed, to see what type of animal you have, what is natural life there, and what would be the impact on the biodiversity in this area following the project. Okay, recording of seabirds, whales and dolphins, numbers and their behaviors. Well, seabirds is an important point for wind farms. You may know that, because a lot of seabirds are just killed because of the wind turbines. When I started to look at this, I thought it was not quite a serious point, but actually there are so many seabirds dying because of that. It is now considered as a serious point when you develop such a project. Recording of intertidal and land-based plant and animals. What would be the impact also on the biodiversity on the land? Analysis of geophysical data. Okay, to investigate submerged archaeology and cultural heritage. You know, there are countries like Greece, for instance, where if you start doing something near from the shore, you might well be just developing a project just above an archaeological site, and this might not be acceptable, or it would mean that maybe you can do it, but prior to the project, you should also take action to protect the site, or at least get what you can get from it before you start the project. Okay, analysis of marine traffic data and existing shipping patterns. For instance, I know that for Legan, there are lots of small fishes going around, and what will be the impact on their activity? Okay, that's a very important point. It should not perturb the traffic, or if it does, you should find kind of possibilities to avoid or to compensate. Engagement with fishing communities, where it's more precise here, to understand how and where they utilize the local sea area. So you see, it's all type of impact. Engagement with the wider community, with particular attention given to vulnerable groups. Yes, because the project might have an impact on local people, on the way they live, and so on. And all these things, you know, should be taken into account. So you see, it was just an illustration, but to show you that it's part of project finance evaluation. Okay, because now it cannot be ignored. It used to be ignored in the past. You know, 10 years ago, well, all these things were kind of, let's say, minor element to be taken into consideration. Today, it has to be taken into consideration seriously if you want to raise proper funds. For certain, for instance, if you don't have this type of analysis, you know, don't expect any subsidies or support from the World Bank, for instance. Okay, because even though the project might contribute to your economic development in terms of growth and so on, too much of negative impact on biodiversity, on the well-being of local people and so on, would lead the decision makers at the World Bank just to reject the project. Okay, and more, even some private banks, you know, private entities, because of the transparency they have to practice with their investors. Well, even private investors, as I've shown you before, are more and more giving importance to these non-economic, purely economic aspects. Okay. Well, just to go on with the Legan project, I've shown you the survey and the main points investigated for the environmental and social impact, let's say. Now, there is also a specific study now which was in the hand of another company called BVG Associates. Here it's more economic, but not economic in the sense, not immediate future cash flows generated by the sale of electricity, but the impact on the Vietnamese economy. The conclusion of the survey was that the economic benefits are mostly derived from utilizing the local supply chain for the development of the wind farm. In other words, that would create jobs and activity for local companies. And the estimate is that total Vietnamese content is projected to be approximately 45% across the full supply chain of the project. You see, so here we take into consideration to which extent the local players are involved in the project. And this is a very important point that most governments would today consider before giving their agreement or accepting to participate and to support the development of the project. Okay, what else? The expectation is to create over 45,000 full-time equivalent jobs in Vietnam. Okay, you have the definition of a full-time equivalent job here. Okay, so that's an assessment also that gives an idea about the kind of social impact, because you provide job to people, it means that it's the survival of families and so on, which is at stake. And a contribution of over 4.4 billion to the Vietnamese economy over the project lifetime. You see, these are pure economic, which are easier to quantify, okay, but they don't concern directly the project. This can be seen as a kind of, let's say, positive externalities of the project. And the last positive externality, which is here good to mention, but not that easy to assess, to measure, there is an increase in expertise of Vietnamese human resources, okay, which could kickstart other areas of the supply chain in the wider offshore wind industry, meaning that in the future, maybe some local companies could be leaders on the development of that project with less, let's say, contribution of foreign companies. Okay, so it's an increase in the expertise and the know-how of in Vietnam, higher technological capability, as we say. Okay, so these are the two aspects, and in the case of Legan, you see that before we start having a pure economic evaluation, a pure, let's say, financial evaluation based on the cash flows generated by the sale of electricity, well, from the beginning, you need to have all this type of more intangible assessments to try to clearly identify both the negative and positive externalities of the project. Okay? Well, so here you have even more detail concerning the types of jobs which are created. I don't need to comment this. Well, I just give it to you for your information, and to show you the level of detail at which this type of survey is done. Well, so now having said that, I guess you have understood the importance of the, let's say, non-financial, let's say, impact of the project. Okay, in other words, what we call the externalities usually. Now let's move to the more financial aspect of it. Okay. And then I will indeed refer to the CAPM, because the CAPM approach provides us with a proper methodology to evaluate the project, and in particular to determine the discount rate that should apply to the future cash flows. Okay, so let's come back to some basics. Okay, and because what you know, one of the problems we have is that if you are a particular company, if you employ some part of your equity in a project, well, you need to know what is the proper discount rate you should use for this particular project, okay? Which is only one project among others, okay? In your portfolio of projects. A company can be seen to a certain extent as a portfolio of projects, okay? This is typically what you see if you take an annual report. And if you look at how it is structured, usually the company would make a distinction between different business units, or sometimes they call it strategic units, okay? And the total amount of funds available for the company can be seen as being allocated in these different projects. So you have a kind of, on the asset side of the balance sheet, you can see the global asset as a global portfolio made of different projects where the company is invested. So we can describe a balance sheet of one particular company like this, with the total capital employed on the asset side, okay? And here we see that there are different units, different business units, 6 business units in my example, each corresponding to a particular activity, okay? For each of these activities, you have indeed a level of risk, more precisely what we call the systematic risk. I guess I'm not going to explain again what the systematic risk is all about. I'm pretty sure you remember the CAPM, okay? It's the part of the risk that cannot be diversified away, if you remember well, and that's why this is the real reference we should take for the risk premium, because we are not going to take into consideration the specific risk which can be diversified away. You don't deserve a risk premium for a risk that can be diversified away through diversification, okay? So if the company is well diversified with many different projects in different countries, in different industries, okay? Well, you can present the total capital employed as a kind of portfolio of different units or different projects. So if, for instance, you're a specialist in, let's say, power generation with a know-how in wind farm, you may have contributed to the development of project company in different places in the world with different technology, okay? And it would be part of one of these units you have in your balance sheet, okay? So you have a beta, beta, which is the systematic risk for each of these units. This is what we call the unlevered beta, okay, or the economic beta. A beta which is not impacted by the capital structure. That's why we call it unlevered. We call it sometimes also the zero debt beta, okay? You might, I guess, normally you should be familiar with that. This is the risk, you know, before the impact of the financial leverage. Okay, you might ask me the question, but where do we find this? I guess you probably know the answer already. You have one guy, his name is Damodaran, and he's famous for providing regularly the updated value for these different beta. For instance, let's click here. I hope I will not disconnect my presentation. So you see, if you go on this website, we will find for a different type of activity, for instance, for let's say engineering construction. Let's look at this one. You have green and renewable energy. That would be good for what we do because we are looking at a wind farm project. Okay, so what do you have here? The number of firms in the sample. Okay, where is it? I have lost my my line. Excuse me. I have lost the. I don't remember where it is. Give me a minute. Here. So I've lost my example of. Oh, it's green. Green. Where is it? Here it is. Okay. So 25 firms. Well, you have the beta, which is measured on the market, but this is the equity beta. Okay. You have the equity beta. Well, the equity beta is 0.98 in our case. Okay. But this is a beta which is a measure of systematic risk, but which takes into account the fact that you have a certain amount of debt in the companies in this industry. Okay. And you have here the debt equity ratio, which is 64%. And you know that the level of debt in the capital structure has an impact on the risk for equity holders. That's why the equity beta is 0.98, okay? Because part of this value is influenced by the level of debt. Would we take out the impact of the financial leverage, the impact of debt on the risk, then if you take it out using a formula, which I will remind you in a minute, you would find a zero debt beta, or what I call here an economic beta, which would be 0.67. You see, what we call the unlevered beta, which is the beta which we have if we take out the debt, if we cancel out the impact of the financial leverage on the risk. Okay? That's why, you know, for any type of industry, you have a beta here, which is the equity beta, which is higher than the unlevered beta, because the equity beta is increased by the impact of the leverage on the risk. Okay, so we can refer to Damodaran, which is a very common practice. Whether these values are reliable or not, that would be another story. We could discuss it. But this is, I just mentioned this one because I guess some of you already know that. Okay, it is very commonly used. Okay, sorry. Can you hear me again? Lynn, can you hear me again? Lynn?
Yes, sir. I can hear you.
Okay, so because I wanted to share my screen. I made the same mistake as yesterday, you know. If I go on the web just to show them something on the web, when I come back to the slide, it's cut. So it's okay now. So
yeah, so it's okay now.
I show my screen. Let me. You see my screen soon coming?
Yeah.
Okay. You have it again. So sorry. I will make sure that it doesn't happen again because it's a bit ridiculous. So here we are. So we can see the capital employed as a global portfolio of business units or of projects. Okay, so the project we are considering could be in one of these units, and the question is, what should be the discount rate for this particular unit? Okay, it can be, for instance, a large company involved in the power sector. Okay, and they might have activities, for instance, with technology with a gas. They could have as a project in nuclear energy, wind farms, solar. So each would be a specific unit with specific type of risk. Okay. So now on the other side, what do you have? You have equity and debt. Okay. And then you have the equity beta, which actually would be a levered beta, because the value of the equity beta will depend on the level of debt. Because if you have more debt in your balance sheet, you have more risk for the equity holders. You know the principle of the financial leverage. More debt means that you have a higher expected return on equity, but you also have a higher risk. And this is reflected in the value of the equity beta. Okay, so the equity beta can be measured on the market for listed companies. Okay, and from this you can infer, knowing also the leverage of the company, you can estimate the economic beta. Okay, well, what is done usually, and it's not always quite reasonable, we usually, very often, implicitly, it is assumed that the beta of the debt is zero. I don't want to get into this discussion here, but this is for the sake of simplicity, but it could be ambiguous. Okay, so I remind you the basic things. For the cost of equity, if you use a CAPM, would be the risk-free rate plus the beta equity times the market risk premium. Okay, I'm assuming that all that is known from you. Then now, how do we link the equity beta and the unlevered beta or economic beta? Okay, this is the formula which is commonly used. The equity beta is based on the economic beta without debt time 1 plus 1 minus the tax rate, TX stands for the tax rate, time debt over equity. Okay, so let's take an example. You are considering a wind farm project. Let's remain with wind farms. Okay, and you need an estimate of the appropriate discount rate. However, this is a new project for the company, and you need to assess the risk associated with the project to determine the appropriate discount rate. What methodology do you suggest? So here, I give you some financial data. The target gearing for the company is debt over equity 2. Again, I will show you later on that it's a bit more complex because it's not easy to get target gearing. But let's assume it is 2 to start with. Okay. The project is rated BB with a spread of 200 basis points, which means that a spread of 200 basis points, you know what it means. It means that if you have a risk-free rate which is 4%, then the interest rate would be 6%, 4% plus 200 basis points. And let's assume that the market risk premium is 5%. Okay, here are the data. So what is the methodology? First of all, we are trying to identify listed companies with a comparable activity and determine an adjusted average unlevered beta. So how can we find comparable? I'm not doing so because I would be disconnected again, but we could look at the list provided by Damodaran, and we have seen that, for instance, for the green and renewable activity, well, we can find an estimate. So based on this estimate of the economic beta, we can calculate the equity beta and the cost of equity, and then finally the WACC. So how are we going to do that? First of all, we need a reference on the market with comparable activities. If you look at Damodaran, okay, then you have green renewable energy. The unlevered beta is 0.67. Okay, this is what we saw in the table before. Now, what would be the project cost of equity? The equity beta is actually defined by this formula. Okay, so the economic beta, we have it from Damodaran, we find 0.67. Okay, the tax rate is assumed to be 30%, and the debt equity ratio is assumed to be 2. So you see, we find this way, based on the comparable provided by Damodaran, we have the beta with 0 debt, then we have the impact of the financial leverage, and we have the levered beta, or the equity beta if you prefer, which is 1,608. So the cost of equity is easy to determine. It will be the risk-free rate plus beta equity times the market risk premium, in other words, 4%, plus 1,608 times 5%, so that you find 12.04% for the cost of equity. Now we know the capital structure because the debt over equity is 2, which means that you have 2/3 of debt and 1/3 of equity. Okay, so the WACC would be 1/3 of equity, and the cost of equity is 12.04, 2/3 of debt. If you take indeed the after-tax cost of debt, you have 1 minus 30%, 6% for the cost of debt, which is a WACC of 681. Okay, so that is the typical methodology which can be used to assess the cost of funds for a particular project, or at least its cost of equity. Well, so now let's have a critical view on the NPV. So I just reminded you the CAPM basics, okay, and the distinction to be made between the zero debt beta and the equity beta, which is a levered beta. Okay, now let's have a critical view on the NPV as you are used to apply it. Okay, here, let's take this very simple example. It's a very simple case, you know, not realistic at all, but just for the sake of calculation and for you to understand some tricky points. Assume that we have to invest 700, it might be 700 million if you like, okay. And this investment, which you do once, would generate a perpetual operating cash flow, that is forever, okay. You would earn 70 year after year, after you have invested 700, okay. What is the equity contribution of sponsors? 200, okay. And you have a perpetual debt. That is, you never reimburse it. It's a debt forever. You will just have to pay interest indeed, okay. So the beta zero debt is 0.6. Beta zero debt, it means the economic beta. The risk-free rate 4%, market risk premium 5%, the tax rate 30%, and the interest rate would be 4%. Okay. What is the NPV? So let's have the evaluation. Here, I just remind you the data. The NPV will be obtained like this. What is the gearing? 2.5. Okay. Why? Because we have 500 of debt for only 200 of equity. So the debt equity ratio is 2.5. The cost of debt is 4%. What is the leverage beta? The zero debt beta is 0.6. Okay, so the leverage beta would be 0.6 times 1 minus 30% times the gearing, and you would find 165. You just use the formula we have just discussed before. So if you use this beta with a market risk premium of 5, you would find a cost of equity based on the leverage beta, which will be 12%. So if you have 12% for the cost of equity, okay, and you have this proportion of equity, and a cost of 4% for the debt with this proportion of debt, then you would find a WACC of 550. Okay, so the NPV is what? Is the discounted value of future cash flows using the WACC. What is the discounted value of future cash flows? It's easy to see. You earn 70 year after year continuously, so it's not growing, okay? And the value of a perpetual cash flow is just the cash flow itself over the discount rate, okay? In other words, 70 over 5.5. This is the value of all the future cash flows. I'm assuming again that you are familiar with this formula. You know, a perpetual cash flow can be valued by dividing this cash flow by the discount rate. You know probably the formula, which is if you have a permanent growth rate, well, it is the same formula, but here, because it's a perpetual stable cash flows, the growth rate is 0. So you have, it explains also the formula you have here. So the NPV is the value of all future cash flow discounted at 5.5% minus the investment which you have to make for that. So the difference will be 573. So this is basically what we do when we calculate an NPV. Yes, but you know, and most people would do that. And now the problem is whether this is quite correct. This NPV calculation follows the current practice, but you know, the problem here is that we are taking book values. Okay, and book values, particularly to determine the debt equity ratio. We take the book value of the equity, which is just the total amount invested, 700 minus the debt. So 200 is the contribution of equity holder. So this is the book value of equity. Does it make sense? You know, when you look at the cost of equity, and probably it's not the first time you hear this, and I hope not. When you determine the cost of equity, as you know, is the required rate of return by equity holders. Okay? If you own shares of a company, if the value of the share on the market is, let's say, 1,000 per share, 1,000 per share on the market is probably something which is totally different from the book value of this equity. Okay? And your reference, if you say, I want to earn, my required rate is 10%, your cost of equity, I mean, what you require on this equity is 10%. So if investors require 10%, it is 10% of the market value of the equity, not the book value. So it is not a good reference to take the book value of the equity to calculate this. Okay, and that leads to a wrong evaluation of the WACC. Okay, so that's one of the difficulty which is very often forgotten with kind of miscalculation. The true value of the NPV is actually lower because the true proportion of equity is higher. You know, there is a value of this project, and the equity value is more than just 200, which was invested by the equity holders. By investing in this, the equity holders, they create value. Okay, so the value of the project is more than the value of their equity is more than 200. So how can we solve that? Let's assume that for this type of project, we can have an estimate of the price to operating cash flow, this ratio, this kind of multiple. Okay, so in this case, if we assume this, and it could be obtained from the market. On the market, you have this type of multiple can be calculated, and they are provided by all type of institutions providing financial data. Okay, so let's assume that the multiple of price to operating cash flow is 5. The operating cash flow is 70. So it means that the value of the equity of this project would be 5 times 70. In other words, 350. Okay? So if you use 350 now for the equity value, and if you have the same calculation, you see there is more equity. So that the beta equity is lower. The cost of equity is also lower because there is less, the proportion of debt is lower. And the WACC is 576 in the end. Okay? Why is the WACC slightly above? Because, you know, in what happened in comparison with the former case, with the former calculation, okay? We have more equity, and because we have more equity, and because equity is more expensive than debt, it contributes to increase the WACC. But on the other hand, if you have more equity, the gearing is lower, and therefore the cost of equity is lower. So you have these two things. So in the end, you nevertheless have a slight increase in the WACC. But if you look at the NPV, you know, the new NPV is 514. It has decreased in comparison with the former calculation. It has decreased by 11.5%. Okay? So you see, normally, if you want to calculate properly the NPV, you need to have the market value of the equity, which is actually not always easy to obtain. You need to have multiples like this. So I wanted to focus on all these difficulties just because, you know, when it comes to project finance with complex capital structure, which are changing over time, going through these difficulties is really tricky, okay? Because you would have to recalculate the value of equity year after year, to recalculate the size of the debt. Even you have more complexity because it's not a single type of debt which you have. So having the cost of debt is very difficult because the debt is changing over time, as we'll see later on. So, you know, you have a huge complexity with project finance, and using the easy approach to NPV is not quite relevant. And that's why we need to look at another approach, a bit more, not, I wouldn't say more sophisticated, because in the end, I find it more simple that using the NPV as we have seen. But I'm now going to propose another approach, which is the APV, adjusted present value. If you take your corporate finance textbook, I'm pretty sure that you have a chapter on the APV, so you can also read that if you want to go further. But the APV will provide a solution that is quite appropriate for the evaluation of long-term project with very complex functioning schemes. Okay, if you don't mind, I'm not going to have a long break today because you probably know that I have to stop 1 hour earlier. Nevertheless, I hope you don't mind if I take a 5-minute break. Okay, so see you in 5 minutes. Okay, no, not too long because, as I said, I will have to stop 1 hour before. Okay, are you okay with that?
C'est un tout petit step. Je ne savais plus où étaient mes bagues.
Ah bah, il fallait me demander.
Ouais, ouais, je les ai trouvées. Je vais faire comme une fois, j'en ai faire
la piqûre.
Il est 4 heures.
C'est sympa comme break. Il est 4h10.
Oui. Hein?
C'est sympa comme break.
Ah oui. T'arrêtes à 5 heures, c'est ça?
Oui.
Je ne me souvenais pas que c'était dans ton portable.
Merci.
Je ne sais pas, qu'est-ce que je l'ai mis? Il était dans l'armoire. On va me vider la valise.
Bon, je vais commencer pour une minute.
Enfin bon, je veux dire, je peux faire ça.
Non, non, il ne peut pas.
Parce que j'ai regardé, mais en fait, je ne cherchais pas dans une enveloppe plastique comme un livre. Je n'ai pas vu au départ, parce que j'ai regardé, je me suis dit, c'est peut-être là.
Bon, tu regardes bien l'heure? Il est 4h15.
Oui, je vais me faire ma pécule.
Je peux la faire. Non. J'ai sorti le papier, je l'ai laissé. I'm back. Are you ready? Yes. Okay. So let's come back to where we were. So let's look at this, let's say, extended approach to NPV, which we call the APV, stands for adjusted present value. So the first point to consider is that practically, the WACC is a concept which is easy to understand, but is it really applicable? In the case of project finance, the answer is definitely no. Why? Because it refers to the debt equity ratio. You need to have a debt equity ratio to know the weight of each source of funds. And it's based, as I said, on the idea that you have two sources of funds, basically, equity on one side and debt on the other side. You probably have heard already with some of my colleagues in certain courses that, you have many type of debt instruments today. You have heard of subordinated debt. You have heard of kind of debt with options attached and so on. So, and you may have heard also this concept of quasi-equity, which is between equity and debt. So, the limit is not easy to establish. And, it has been sometime long discussion to know whether some instruments could be considered as equity or debt. So, and not only this, it's not only the question of limit, it's the fact that you have different types of debt with different characteristics. Sometimes you have risky debt. So you see, the WACC is really not easy to calculate because what are the different categories, how are you going to distinguish between what is debt, what is equity, and so on? So practically, it's complex. It is also more complex in project finance. Why? Because even if you have a certain capital structure when you start with a certain amount of debt, okay, and a certain amount of equity, over time, it does change. Not only the proportion changes, but also the nature of the debt. For instance, we will start with mezzanine debt, which is a very specific type of debt, you know, which usually we call subordinated debt. Okay, you may also have preferred shares and so on. Just because you remember maybe that during the completion phase of the project, that's where the risk will be at the highest level. That's why we need to have risky investors. We have equity, but we also have all type of debt instruments which are kind of risky debt. And then after that, you know, these guys, they get out because once we reach the operational phase, well, of the project, well, the risk is much lower, and then you have newcomers, and they fund the project with what we call no recourse debt, which is a total different nature of debt. So not only there is a change in terms of proportion of debt and equity, but over time we also have a change in the nature of the financial structure in terms of what type of instruments are used. Okay, so the WACC is nearly impossible to apply seriously, correctly, in the case of a project. What's next? One point we need to consider, however, which is a crucial point, and this is why, you know, debt is important, because debt is cheap. It is cheap for two reasons, because the cost of debt is usually lower, normally lower than the cost of equity, but also because the cost of debt is tax deductible. Okay, and that's a reason why debt is value enhancing. Okay, because it brings the cost of financing down, and it generates a kind of cash flow, which is a tax shield. We call it a tax shield. The tax shield is the amount of money you save by paying less taxes. You know, the tax shield is a cash flow generated by the debt in terms of lower taxes to be paid. Okay, and this is an important point because the APV is based on a very simple idea. The idea with APV is to value the project with the cost of equity only, assuming zero debt. So you start with the idea that you have zero debt. You forget about that. And therefore, you value the future cash flows with the cost of equity only, but the cost of equity as zero debt. Okay? And remember, that is without the impact of a financial leverage, okay? And then we take into consideration that debt would generate value because of the tax shield, okay? So just a remark here, I'll come back to it. You know, you have to know that would you use the WACC properly with a change in values of, you know, of equity year after year, with the change of the capital structure, very complex calculation, we could prove that the two solutions would end up with the same result if you assume indeed an efficient market. Okay, so the main advantage of APV, it is much easier to implement. So how would you do that? The APV is what? The present value of operating cash flow at the cost of equity, considering a cost of equity for zero debt. Then, to take into consideration the impact of debt, you will value the tax shield. And you value the debt tax shield. The question is, what discount rate are you going to use to value the tax shield? You need to have a discount rate which has an appropriate risk premium. What is the risk associated with the debt for the lenders? It is the default risk, the risk of not getting that money back. How is it integrated? It is integrated with a spread. In other words, the spread on the cost of debt is a good, it can be seen as a relevant measure of the risk premium that applied to the debt instrument. Okay, so if you want to value the tax shield is not here for certain, because if the company is not doing a profit, there is no tax. Okay, so there is a volatility of the tax shield. Okay, but how can you assess the risk of it? Well, this is the same as assessing the risk of negative profit okay, which is rather well taken into account by the spread. Okay, so if you consider that the spread of the debt is a good assessment, a good estimate of the risk premium that fits with the debt instrument, then you can use the cost of debt to discount the debt tax shield year after year. Okay. So let's take the example we had before. Let's assume that the cost of equity or zero debt would be 7%. So if you value the cash flow at this rate of 7%, a perpetual cash flow, as we had before, so the value of all the future cash flow would be 70 over 7%, which is 1,000. What is the tax shield? The cost of debt is 4%. Okay? The level of debt is 500. Okay? And your tax rate is 0.3. Then the tax shield is 4% of 500, which is what you have to pay each year. Okay? But since it is tax deductible, in comparison with a zero debt case, you have a tax shield of 30% of that, which means 6. Okay? So what is the value of the debt tax shield? Year after year, you have a debt tax shield in our example of 6, which you will discount with the cost of debt, which is 4%, which means 150. In this case, in our case, the APV would be minus 700, which is the investment, what you have to spend to start with, plus the value of all the operating cash flow generated in the future, year after year, using the zero debt cost of equity, okay, plus the value of the tax shield, which is 150. In other words, altogether 450. Okay, and I remind you that here both methods lead to the same evaluation with NPV calculated rigorously. So, well, so maybe you want to have a more precise exercise. Okay, that is a bit more realistic. So let's do it together, and after that you have another one which you can do alone at home. Okay. So we assume that you invest in a project and the cost is 130,000. And you invest all of it year zero. You have depreciation over 5 years, straight line depreciation. The sales are starting year 1. Okay, they are stable over the years. You assume that you sell year after year 100,000. The EBITDA would represent 40% of the sales. We take a tax rate of 25%. To make it easy, we have no working capital and we have no terminal value. Okay. Cost of debt, 10%. Okay. Cost of equity at zero debt, we have 10%. What about the debt? Tranche 1, you have 2 tranches. At the market rate, an amount of 30,000, which at a rate of 8%. And a second tranche, which is at a subsidized rate, okay, an amount of 10,000 with a rate of only 3%. Okay. Tranche 1 at market rate, repayment 5 annuities starting year 1. So each annuity would be this. Okay. I've calculated the annuity for you. Tranche 2 at subsidized rate, interest paid each year, and the principal repayment in full at the end of the project. Okay, so we have a bit something a bit more complex, more realistic here. Okay, so the question is, first of all, determine the free cash flows. That will be easy. Determine the debt tax shield and their value, and determine the value of the loan subsidy. Because as you'll see, the APV will help us also to determine the value of a loan subsidy, which is usually not taken into account if you are not careful when you use a WACC. Okay? And we will calculate the APV in the end. So this is a cash flow statement, simplified version. Years, sales, debit, depreciation, and so on. So I don't need to make comment on that because we have no change in working capital because the working capital is 0. Okay? So you recognize a traditional cash flow statement, sales, EBIT, depreciation, EBIT, sorry, I made a mistake here. It's EBITDA indeed. Okay. You have EBITDA there and EBIT here. I'm sorry for that. Okay. Then you have taxes, the NOPAT, depreciation again to calculate the cash flow. You have the cash flow from operations, you have investment and the free cash flow. Okay. So then you will have an amortization table for all of the loans. Okay. This is what we need for the taxes. So I will move ahead just to give you the different values immediately. So here you have all the cash flows, and I take just 5 years. So the sales are these. The EBITDA, you have the same mistake here. You should write EBITDA, okay? Is 4,000, 40% of each, so it's the same each year. Then depreciation is, 26,000 year after year, which is based on the assumption we have made. So that the EBIT is 14,000 year after year. Okay. Taxes, 25%. So you have 3,500 year after year. Okay. So the NOPAT is there, no problem. Then you add depreciation because it's not cash out, normal. Okay. And you have a cash flow from operation which is there. The investment to start with is there, so that the free cash flow is this one. Okay. So if you discount the free cash flow at the cost of equity of zero debt, which is 10%, then we find all these values. If you assume a period of 5 years for the horizon, assuming there is no terminal value for the sake of simplicity again, okay, then you have a present value of free cash flow at this rate, which is 8,364. So that is for the simple part, which is the calculation of the discounted value of free cash flow using the cost of equity at zero debt. Now let's look at the debt. The first debt, you have an annuity. It's a debt of 30,000 with an annuity of 7,514. Okay, and I guess how to determine an amortization table. So you have the annuity, which is the same year after year. Here you have the interest which is 8% of the amount of the debt at the beginning of the period. If you take out the interest payment from the annuity, this is the amortization, and this is the level of debt at the beginning of the second year, which is there, and so on. So at the end, you have zero debt left, indeed, and you have a decreasing cost of interest, and you have an increasing amortization part. Okay? So what is the debt tax shield? For the tranche 1, you have the interest here. Okay? The interest is, for instance, 2,400. Okay, so 2,400, if you have a tax rate of 25%, so it means that the tax shield is 600. In other words, because you pay this amount of interest, you reduce your taxes by 600. And this is taken as a kind of positive flow due to the debt, okay, which is 600. Year 2, it's only 498. Why? Because now we're going to take 25% of a lower amount, which is 1991, and so on and so on. So the tax shield is decreasing just because the interest amount decreases year after year. Okay. What about the tranche 2? Okay. Tranche 2, you have an amount of a loan, which is, I don't remember exactly how much it was. So you have a 10, and I think the rate was 3%. Okay. So, okay. And this is, so you have, excuse me, I have to come back to remind me the rate at which, subsidized rate is 3%. So the rate is 3%. So if we take a rate of 3%, if we look at this, so 3% for an amount of 10,000. So 3% of 10,000 would be 300. And if you take 25% of this, you have a tax shield 75. So the tax shield will be the same year after year because you repay the loan only at the end in full. Okay, so you always have the same amount of interest and therefore the same tax shield year after year. Okay, so the total is there. So, and you see, you are going to take the total here, and you know, I'm going to treat the tranche 2 exactly like tranche 1, assuming that I have a tax discount rate, which is the market rate. Why? Because after that, we will have to determine the value generated by the subsidy, because a rate of 3% is not a normal rate. It's a kind of, you have a subsidy hidden in this rate, okay? And we have to value this. So we are going to consider that tranche 2 normally would cost not 3%, but the 8% similar to the first tranche, okay? So that's why here I'm discounting all these, let's say, tax shield at the same 8% rate. And you find this amount here. So you have a present value of the debt tax shield, which is 8081. Now, if I want to value the loan subsidy, what should I do? The interest payment at market rate is 800, which is what we have assumed implicitly in the table below. Interest paid is only 300, okay? In other words, we have a subsidy of 500, okay? The after-tax subsidy, okay, is 375. And therefore, the discounted value of subsidy using the market rate of the debt would give you that, okay? So if you look at the present value of subsidy, you have this. Now the APV, okay? The APV, you know, is made of different types of elements. The MTV of the cash flow using the cost of equity at zero debt, which we have done before, the value of the tax shield, and we have a third element here, which I have added for you to understand that the APV was a very useful approach because you can always add different elements which can be assessed separately. Okay, and that's typically the case for the tax shield, but also for a loan subsidy. Probably you have seen that in corporate finance, how to treat a loan subsidy. It's typically what we do here, but here we integrate it in the APV and using a specific discount rate, which is the discount rate that would apply to the debt. Okay, so altogether we have an adjusted present value, which is 11,742. Okay. You see that in this case, would we like to calculate the WACC? The tricky issue is that the amount of debt is changing year after year. So normally we should have to adjust the WACC year after year. And also we have to recalculate, to reassess the market value of the equity year after year. If you want to be rigorous with the NPV, meaning you should take equity values at the market value, and also take into account the change in the debt structure, well, you know how complex it is. If you lose the APV, you see that it is quite simple in a way. Okay? You have another case here, which I'm not going to treat with you now, but I strongly recommend that you do so. Okay? Full table here, and you have the result. Okay? Now to the let's go a bit beyond elements. APV, as we've seen, basically you start with the present value of operating cash flow and the cost of equity. I hope you have understood this. And then we have the tax shield. So we take the present value of tax shield. Then some people would argue that if you consider depreciation is in the cash flow, okay, because it's not cash out. And what is the interest of depreciation? It is the fact that it's tax deductible. Okay? Without tax, we wouldn't need to look at the cash flow. We do, we take out the depreciation to the EBIT, but we after, because it's not cash, so you see with of the depreciation impact. Tax impact is if the company is profitable, it is obtained for sure. We know exactly how much it is. It is just tax rate times the depreciation. Okay. In other words, you could look at depreciation exactly as we treat the tax shield. Okay, and that's why some recommend to, when you see the APV, isolate the depreciation from the operating cash flow and to treat depreciation tax shield exactly like we treat the debt tax shield. Okay, so I just indicated that to you because you may find it some time. Well, it is not so common, but it may, and there is justification for it. Well, and we may also treat all type of other components. Okay, it might be positive or negative components which deserve a specific discount rate different from what is used for the cost of equity. And that's, I give you an example. For instance, if in projects that save CO2 emissions, well, you can benefit from rights which have a certain value on the market, and this can be treated separately and added to the present value of operating cash flow. You know, it's a line in the cash flow generation that can be isolated with a specific discount rate. In other words, you know, with the APV, what you see, and the difference with the net present value. With the net present value, we have a discount rate which applies to everything. Here, the idea is to say, well, let's isolate the pure operating cash flow, which will be discounted with the cost of equity at zero debt. And then let's treat all the other elements. Okay, and the other elements are to start with the tax shield. It can be also, as we have seen, the value of a subsidy or a loan. It can be specific components, like, as I say, some certificates due to the fact that you have a low CO2 emission, and so on and so on. Okay, so just to conclude on this, you know, the APV is a very useful approach. It makes things much more simple, and that's why in your assessment, I will be more precise in the days to come to tell you exactly what you will have to do as group work, but you will have to evaluate a project with some element of complexity, and I will ask you to use the APV. Well, now, what can we add to this? Now in a step. APV is an improvement in terms of valuation, particularly when we look at complex investment project, which is typically the case in project finance. The complexity coming from the fact that capital-intensive project with a lot of debt invested, okay, a long duration, and a changing and complex capital structure. Okay, so the APV is very useful for that. But now there is still a limit of the APV, which is also a limit for the NPV. That the APV as well as the APV would not take into account flexibility. You know, it doesn't take into account, it doesn't make any difference if you compare two projects, whether in one case you have the flexibility to adjust your project to new information that will arise in the future, or whether you have no possibility to do so. This is not taken into account in the net present value or adjusted present value. So this is now a point which we need to discuss a bit. Okay, how to value flexibility. So the solution is to look at what we call the expanded net present value, or it could be indeed the expanded adjusted present value. And the idea is to start with the static NPV. What do we call the static NPV? It's a traditional NPV. In a traditional NPV, what do? You say, well, I'm going to invest this amount. And what are the future cash flows? You will take the expected cash flow. You know that the cash flow are uncertain. And then you will take the best guess for each year, the expected cash flow. Okay, and you will discount these expected cash flows. When you take this expected cash flow, well, you are not considering weather. You are just considering the information you have now. Your expectations, your provisions, okay, are based on the information you have today. Okay, that's why we call it static, because it's based on information available now. And it doesn't take into account the fact that later on you may have information, and this information would be valuable. So if you have the possibility to adjust your project to the new information which will be available later on, you increase that value. But this value is taken into account that you approach. For example, if you consider investing in a new country, okay, I'm a European country, I'm a European investor, and I plan to have a new project in Vietnam, okay? I would like to launch a factory there to maybe to do things in Vietnam and sell all over the region, the Southeast Asian region, okay? Well, I say, well, I'm ready to do that, but it really depends on the evolution of the situation between China and the US, or it may depend on you know, what's going to happen about the regulation concerning this or this, you know. So I'm ready to invest, but I don't know really what's going to happen in the future, so I hesitate. One way to do it is to say, well, the other problem might be also that if you don't invest now, it will be too late. It might be too late to invest later on. Okay, so what do? Well, the traditional approach, strategic approach usually is to say, well, let's invest now. Not a full investment, just a kind of, you know, first investment just to see how things are going. I may lose money because if I look at the net present value of this project, it wouldn't be quite positive, but I still invest there because if things turns out to be good, I will have the chance to take this opportunity, okay, and grow, and then I will be highly beneficial. So you see, in other words, this first investment could be seen as a kind of option. You invest to take the option to grow later on. Okay, this is typically the type of problem we are dealing with here. You have a first step in the investment because you know that, you know, later on, depending on the information you're going to have, you will decide whether you go further or not. This is typically what flexibility is all about. Remember in one of the projects which I have introduced to start with, this project of this wind farm project in Belgium. Well, for investors, there is always an issue to know whether the project will be successful or not. We would like to know whether it's feasible, and we would like to have the proof of that. Well, that's why usually you have a phase one. And then we had phase one, if you remember well, with phase 2 and 3 after. Okay, phase 1, it's only 5 wind farms, wind turbines which were installed. And this, you know, at the end of this first phase, well, then we would have the information on whether the project is feasible or not. Okay, that's a typical case of flexibility included in the project. So how can you value this? Well, you can refer to the value of real options, to value of options. You know what an option is. I'm pretty sure you've discussed this point with my colleagues, okay, in finance. A traded option, you know what it is. For instance, you can have an option for to buy dollars, to have the opportunity to buy dollars later on at a price which is fixed today. And an option in general is a right to do something, but not the obligation, okay? So, and you can value it using valuation models. And I'm pretty sure also that most of you are familiar with option valuation, okay? Well, so now what are we going to consider? What are the types of embedded options for the different projects we may have to look at? For instance, a project may provide you with the option to wait, okay? Wait, why should you wait? Because you are waiting for an information, but you have to invest because otherwise you will not be able to take opportunity of this new information. So you wait and see, okay? So if a project provides you with the option to wait, for instance, you might, to develop a project, you may need a piece of land, okay? But you are not sure whether the project will be feasible or not. But if you don't buy the land, well, you will not have the possibility to invest later on. So if you buy the piece of land, it gives you the option to wait, to see whether later on you will develop the project or not. Okay? An option to grow, which is what I explained before. You invest in a country with only just a small investment, just an office in the country maybe, to start developing a commercial network and so on, okay? And you will see if things happen to be good as you would expect, then you will have the option to grow because you have a presence, and this presence is necessary to grow further. So this is the option to grow, okay? The option to exit is also very important, Do you have in the project, in case it turns out to be not as good as you did expect, is it possible to get out of the project in good conditions? Okay, this is also a source of flexibility which needs to be valued and which can be seen as an option. Okay, so, and you may have many other options. And here I give you a reference of a paper concerning the energy sector with an illustration of the use of real option in this industry, So what can you do in this case? You still use the net present value as usual, or the adjusted present value. But in addition to this, you try to see what are the options which are embedded in the project, which create value, and a value which is not taken into account in the net present value approach. Okay? And so there are some evaluate options, okay? And the basics. Well, it's possible an option for financial market. If you have an option on the dollar market, for instance, you have the volatility of the dollar, you have and we can, based on this historical data, on the probability distribution of the dollar and so on, the striking price and so on, you can use the option, okay? But when it comes to real option, for instance, the option to exit, that is the right to exit in good conditions. It is an option because it is a right to do something and not the obligation, okay? But you have no historical data, you have no data to value that. So the idea is not to really take a number, try to get a number for the value of the option. The idea is to say, well, let's look at the NPV or the APV, and let's assume that it is negative. Well, before saying, no, we are not going for the project, you should ask you, yes, but maybe if there is some flexibility in the project, this is a value which is not included in the NPV. And maybe the value of the options which are embedded in the project would be high enough to compensate for a negative NPV. Okay? In other words, the idea is not to value precisely each of the options embedded in the project, but to try to see whether it's a kind of approximation, but whatever the value is, would it be high enough to justify the investment? Okay, so the idea is not to fix a clear value, but to try to see whether the valuation, whatever it is, would be high enough or not to justify the investment as a complement to the NPV. Okay, so again, for those of you who are not too familiar with real option concept, I recommend also that you look at your corporate textbook. I don't remember which corporate textbook you have, corporate finance textbook, but there is a chapter also on real option, which is quite interesting. For those of you who would be interested in real option, particularly in the energy sector, well, you have this paper, which I recommend because it's quite interesting to see how it works, and it gives you a better view of what this option, expanded net present value within integration of possible options is concerned. Okay, well, so now, so far, I have looked at the different methodologies that can be used to value a project, particularly complex projects like the type of infrastructure projects we are considering. Okay, we said that there is a difficulty with using the net present value as we use it traditionally because of the complexity in the function scheme, because the fact that things are changing over time, and also because for many of the projects, there are some embedded options that should be taken into consideration. Okay, good. But now there are other difficulties which we should consider, okay? The other difficulties come from the fact that most of the projects are offshore projects, okay? And offshore project, it means that for investors, they are not investing in their country. They are investing abroad, okay? And usually they have portfolios of activities all over the world. So in this case, there are 2 points to discuss. First, several points, 3 to discuss. First of all, the projects are multi-currency projects. Okay, so when you have cash flows, they might be in one currency, but the funds might be raised in several currencies. You can raise, you can have loans in yen together with another loan in dollar, another one in euro. Okay, how do you handle this complexity? Because the exchange rate might move up and down. Okay, so that's a difficulty, this offshore dimension of most of the project. The second one is, well, the cash flows are denominated in a currency which might be different from the investor's home currency. If I'm a European investing in a project in Vietnam, and if the cash flows in Vietnam are generated in dong, Vietnamese dong, well, that's a problem to me. I need to consider that point. How am I going to treat that? Okay. Last but not least, I have to integrate the country risk. Okay. If I invest in a particular country where there is a particular level of risk in this country, how should I take into consideration the country risk in my valuation, in my project valuation? How will it affect this particular type of risk? How will it affect, okay, my discounting, my discount rate in particular? Okay, so these are 3 technical points which are important to discuss. But I'm just looking at my watch. I told you that I had to stop a bit earlier today, so I'm certainly not going to start this point right now. So. Sorry for having to stop right now. It's just due to the fact that I thought I would start earlier. Okay, and I have a strong commitment tonight. To be frank with you, my commitment is I have a flight very soon now, and I don't want to miss my flight because I have to be. I was talking to you from Greece, you know, and I will be talking to you tomorrow from Paris. Okay, so I will quit now and say you. Bye-bye. At 9 French time. So I let you estimate. I let you estimate your time in Vietnam. I think it's the right time, isn't it? It's the right time. So for you, it should be. It should be 9 and 5. It should be 2 o'clock for you tomorrow. Okay. So bye-bye.